दोनों को करने का हिसाब में। अच्छा फिर एग्रीमेंट अब किस दिन करते हैं, बाद में किस दिन होता है, हम कैपिटल गन यूज़ किया, अब दोनों में फंसाने का काम करते हो मेरे को। जरूरी है तो इनकी क्यों माइंड में है, वाई डू
मिस्टर खंडेलवाल, मिस्टर चुखानी,
एक्चुअली जो आप बोले बिल्कुल सही है।
डॉक्टर गुप्ता,
क्यों समझते हो आप, साहूकार समझ के बात करने का काम।
other dignitaries and my dear learned delegates. I was wondering, this being the fourth session, is it a small get-together of the office bearers, me and the MC who I pity the most? She has to stay back right till the end.
If I can disturb you for 1 minute, for the good cause of my participants, there is a lucky draw after this particular session. So be with us, bear with us, enjoy the lucky draw and take the prize with you.
You have been unlucky to stay for the first session. Maybe you would be lucky in the lucky draw. See, the real estate topic is a rugged one. And it looks all the more rugged because we are in the fourth session, Saturday evening, where you should be spending your time in a much better manner than what we are doing now. When I was hearing Dr. Gupta's well-analyzed and a very detailed address on search and survey, I could only recall an incident in Bangalore, case of a realtor, very famous realtor. Such takes place. This guy is not just a realtor, but also a rugged one. The search party poses a question to him. He would insist that the search party writes the question as well as the answer, because he has to, end of the day, sign the statement. He answers first 3 questions. The fourth question, the search party, whatever fourth question she would ask was almost the same as the second question. So this guy says, don't waste my time asking the very same question. She looked aghast. He insisted, you are expected to write all my answers. This is my answer, write this. This is my answer to your fourth question. My answer is, this is a stupid question, write that. So he in fact made the search party sweat. Not that we should be doing it. Let us cooperate in the best of our respective interests. And with this transition from search to the realtor, we will now move on to dealing with real estate transactions. As we are a reasonably small crowd, thanks to not giving the tea break. Otherwise, you know what would have happened? If there were a tea break, then outflow would be less than the inflow. So that is why I generally was checking either a tea break. They said, no, tea would be served here itself. As we are a small crowd, let us not have any this question answer session in the end. I'm sure we will not have either the time or the patience to be discussing all niceties of real estate transactions. We'll just be dealing with a few topics which could be matter of interest or concern to us. Matter of interest to us, matter of concern to the clients, because more his concerns are, our interests would only grow. Isn't it? So please ask questions as and when the questions arise to you. We would rather take it as some sort of a discussion rather than a lecture by an inexperienced person to the more elite set of delegates. Right? Now we will have, so typically I've chosen a joint development kind of a situation where we have a lot of burning issues. If it were just the case of sale of a plot, a sale simpliciter, then he needn't have to go to a chartered accountant or an advocate to know his tax stuff. He'll have to pay the tax in the year in which the transfer takes place. So the difficulties arise largely in the case of the joint development situations. So in a typical joint development, you will have the landowner on one side and the developer on the other side, who would behave like India, Pakistan, So when they sit together to initially negotiate, they are the best friends. As the project evolves, they become sworn enemies. So we'll have a lot of issues that would arise between the two. So here also, for the sake of discussion this evening, I have classified the issues that would concern the landowner on one side and the developer on the other side. Now, take the case of landowner. I'll only enlist these, and depending on your interest, we'll try to discuss. The characterization for the landowner as to whether the income would be business income or the capital gain. No great discussion would be necessary for this. As Lord Holmes once said, when there's a doubt in a highly complex issue, don't spend your time, don't waste your time in discussion. Take the coin, decide head or tail, and toss it. So this is what we'll have to do to decide as to whether it has to be offered to taxes, business income or capital gains. The most crucial thing is the timing of tax. Because some artificial circumstances have been enacted in section 2 within brackets 47, which would create time mismatch between your income to be earned and the tax to be paid out. So you'll be out of cash in terms of tax, but you wouldn't have the sale proceeds reaching you as it. So we'll have some serious concerns on time mismatch of section 2 within brackets 47, where we will have to be discussing how to possibly deal with certain situations. Then the consideration. Typically in the joint development arrangement, the consideration, if it were to come by way of cash, there is no difficulty in determining the consideration. And it is the full value consideration that is the starting point as you compute the capital gains under section 48. Where the consideration comes either wholly in kind or partly in cash or partly in kind. And now that we have section 50 capital D being in place, how do we deal with this kind of a situation? Then the landowner would get, in a given situation, some built-up area as owner's share in lieu of he giving away the developer's share of land. So the super built area that he would get in terms of a few flats, a few office spaces or whatever, when he sells them away, like you will have dual gains arising to him. Because the undivided interest in land continues to belong to him, and possibly it would be long term. Whereas the super built area that would come to him, which he will be wanting to sell away fairly quickly to realize cash, could be largely short term. So we will have some sort of a dual gain situation where the consideration that he would get on sale of the super built will have to be attributed A towards undivided interest in land, B towards the sale of built-up area, and you will have differential tax treatment in respect of these two streams of consideration. Then, of course, we'll have incentives. Then you'll have the TDRs which the landowners at times could be sharing with the developer. Then you will have 194IA is another situation which could at times make landlord wonder as to whether he will have to be deducting tax in respect of the consideration that he would be getting. And the consideration which the developer would get, is there some sort of a cross TDS situation under 194IA also will have to be examined. Now, as regards these issues which would concern the landowner, I would touch upon the timing of tax and the consideration with a little greater emphasis, subject to your concurrence and you wanting to discuss any other topics depending on the availability of time. Now, as regards characterization, as I've said earlier, we will not have to discuss much about it. You're all veteran chartered accountants. You would know under what circumstances your investment will have to be regarded as stock in trade, under what circumstances your investment will have to be regarded as a capital asset. You will have the board circulars, 1827 circular 4 of 2007, issued in the context of the stocks and shares, but the principle should largely apply even in case of the land which you are holding, depending on the intention which you have been holding the land, the way you have been dealing with the land, one would characterize land as inventory or capital asset. Now, coming to the timing, you have section 2 within brackets 47, which would give different types of transactions to be regarded as transfers. The most common transaction we have is sale. Section 54 of the Transfer of Property Act defines what a sale is. And we have always believed that sale will have to be understood by applying the principle of nomen juris, as how the whole world understands what a sale is, which wouldn't require any particular definition as such. But beyond sale, there are various instances which have been brought in as transfers. You'll have sale, exchange, or relinquishment of an asset, extinguishment of rights in an asset. Then you will have the compulsory acquisition. These are some of the aspects which have been brought in within the scheme of section 2 within brackets 47. But what would trouble us most, particularly in the scheme of JDA, would be 247.5 and 247.6. A department has been quite familiar, more particularly with 247.5. At times they ignore 247.6. Even as consultants, thanks to the way we have been dealing with the department, we tend to give a lot of emphasis even as we draft the JDA, so as to circumvent a situation of we having to come under 247.5, but we may ignore 247.6. So these two provisions will have to be kept in mind when you would deal with the case of a landowner. Now what does 247.5 say? These two clauses have been introduced by 1987 Finance Act as a mischief rule, because they have found that through these means, while the domain over property is as such dispensed with, the bulk of the consideration otherwise having been received, there is a tendency on part of the taxpayers to eternally defer the taxation. They eternally defer the taxation. This eternal deference of taxation could as well mean tax avoidance insofar as department is concerned, for which reason they have brought in these two clauses to plug the loopholes. Now 247.5 talks about the transaction that would involve allowing or retaining the possession of an immovable property in part performance of the contract of the nature referred to in section 53 capital A of the Transfer of Property Act. What is 53 of the Transfer of Property Act? It just says where there is an instrument of contract in writing in respect of an immovable property, where the terms of the contract are reasonably discernible as you read the written agreement. And if the agreement is registered, and if the proposed transferee has taken the possession of the property, or if he is already in possession of the property, he continues to retain the possession of the property in part performance of the contract, then the proposed transferor cannot, either through himself or through anyone else, enforce any rights against the person in possession. So it will give you possessory rights to the proposed transferee, although the conveyance as such has not taken place, although sale deed as such has not been entered into and not registered. Now, once there is a transaction of the nature referred to in section 53 capital A, although it has not fructified into sale as yet, law would step in to call it as a transfer much ahead of the actual transfer. And when a transfer like this takes place, what are the difficulties that would be faced by the landowner? The most important difficulty for the landowner would be the immediate outflow of cash without the inflow of income as such. Particularly when in the JDA, landowner in lieu of his land would get the built-up area much later, 3 years, 4 years, 5 years. We do not know when. Whereas in terms of 247.5, there is an immediate outflow by way of cash. Secondly, we had earlier section 54, 54F, where we used to interpret A as many. Under section 54, you are expected to invest in a residential house. A means A, any, many. So courts interpreted word A will not have to be read as restrictive. It would only qualify what a residential house is, and accordingly it is possible for anyone to be investing in multiple houses and still get the benefit of 54 as well as 54F. So whereby a landlord who would have come under 247.5, possession having been given to the developer, would have otherwise suffered tax, would now not have suffered tax thanks to him claiming all the houses that would come to as his share as reinvestment in house, and would claim the benefit of 54. Did you get me? Now, after Finance Act of 2014, where in order to undo the effect of various decisions which have unanimously held that you could go in for investment in multiple houses, the Parliament has amended to say that it has to be only one house in India. Now, the problem is aggravated for the landowners now, because he could get the benefit only in respect of one residential house. When he gets multiple houses, in respect of those multiple houses, there is an imminent outflow by way of tax. And there are situations where the JDA, which meant giving away possession and thus meant tax, now in the year in which the possession is handed over and the year in which the JDA is entered into, if the JDA is subsequently cancelled, or it reaches a stage where the developer has run away from the scene after 3 or 4 years, by which time you would have paid the taxes, there is no mechanism within the tax statute to give you any relief except by of possibly 264, but we know how 264 is being used. Next difficulty for a corporate landowner, if you are a company and you own land and you give away land in terms of a JDA, you would pay tax in the year when you wouldn't have booked it as income asset in year 1. Whereas in year 3, real income comes to you, which you would actually book in your books of account. That would make you pay minimum alternate tax. So on the same income, there is a tax twice over for a corporate taxpayer. And courts have of late been holding that the book profit could be fudged only to the extent provided in explanation to 115 JB1. Not beyond it either way, either for the assessee or for the department. You have the Apollo Tires case 255 ATR 273, where the jurisdiction or the power to alter the book profit would not transcend beyond the various circumstances which are given in explanation to 115 JB. Now, the problem has been aggravated by one of the latest decisions of the Honorable Supreme Court in Sanjeev Lal's case, 365 ATR 389. Decision is a benevolent decision, but then it creates a lot of heartburns to the landowners. With due respect to the Honorable Supreme Court, this decision is to be reviewed. Shouldn't stay as such, has to be upset. I don't know how many of you have followed this particular decision. I'll just try to make it as simple as possible to explain the facts of this case. Here is a situation where in year 1, I agreed to sell my house. I agreed to sell my house. The proposed buyer with whom I have entered into an agreement to sell my house will give me advance in year 1. The advance which I receive from the proposed buyer, I would invest in another house in year 2. In the meanwhile, there is a suit filed against me claiming title on the property. Therefore, the agreement which I have entered into with you in year 1 could not be translated into a sale deed. You followed me? Year 1 agreement, year 2 investment by me, thinking I would get the benefit of section 54. In year 5, after the litigation is resolved amicably, I would actually transfer the property to you in year 5. Which year should I offer it to tax? No possession was given. Year 1, only an agreement simpliciter is entered into against payment of 50% advance. Year 2, I've invested in a new house. Year 5, actually execute a deed of conveyance in your favor. Which year I should be paying tax? Which year? Year 5, correct. Not in the year of agreement. Because, merely because you enter into an agreement where no possession is handed over, there is no case for you to be calling it as sale or a transfer under section 2 within bracket 47. So I offer it to tax in year 5, rightly so. But I continue to make a claim of section 54 in respect of the investment which I made in year 2. Now the department says, technically rightly, department says, look, under section 54, you could reinvest, you could roll over in another house, right? Within 1 year from the date of transfer or within 2 years from the date of transfer, if you'd go for purchase, if you could go for construction, within 3 years. In your case, you have gone in for the purchase, so you could go backwards up to 1 year. Year 5 is when the transfer has taken place. I would understand if you had done the investment in year 4, but which year did you make the investment? year 2, you will not get the benefit. Department is technically right. Very technically they are right. And they are not expected to be reading it very liberally, unless you are too liberal with them. Isn't it? Now, the matter goes to Supreme Court. Supreme Court, if it intended to give the benefit to the taxpayer, could have done so without damaging the statute by saying that after all section 54 is what? It's a beneficial provision. Supreme Court in Arvind Reddy's case has held that 54 has been enacted to encourage housing. And in this situation, there is a maxim called lex non cogit ad impossibilia. For no fault of him, the registration could not be completed. Otherwise, the intentions are very clear. He never expected a suit being filed against him. So that delayed the registration of the property. Therefore, very liberally interpreting section 54, as long as he's committed his funds, we would somehow give the benefit to him. Could have been good enough, where it wouldn't have become the ratio. But what the Supreme Court did is it went a step ahead to say that, look, in year 1 when the agreement is entered into, transfer has taken place in terms of section 2 within brackets 47. Because in year 1 the transfer has taken place, the investment that has taken place in year 2 is within 2 years from the date of transfer. And therefore, the assessee is eligible for the benefit of investment. And they did hold so, particularly in the context of section 2 within brackets 47, without in fact examining any of the particular subclasses of section 2 within brackets 47. And the funniest part of the decision is, after having held that the transfer has taken place in year 1, and therefore the assessee is eligible, they send the case back to the assessing officer to afford this benefit for the year 5. Do you see some sort of mismatch here? See, if according to Supreme Court the transfer has taken place in year 1, entire assessment should fail for year 5. Where is the question of giving benefit of 54? Because in year 5, it is not even the year of transfer in the words of Honorable Supreme Court itself. So now the assessee will have to go to the tax guy now and tell him, look, the Supreme Court has said what? The transfer has taken place in year 1. Now, I have wrongly offered it to tax in year 5. I'll withdraw the demand, I'll withdraw the assessment, whatever I've offered, and you refund the entire taxes to me. I don't want 54. See, had the Supreme Court relegated the matter back to the assessing officer, it did not for a while appreciate the, error that it is committing. But now that it has become some sort of law of the land, from the point of view of the landowners, department would be more aggressive now. Look, if I entered into an agreement in Sanjeev Lal's case, Supreme Court has said it's the case of transfer, pay tax now, in the year in which the agreement is entered into. There was no possession given at all in Sanjeev Lal's case. See, that right is always there. Basically, what you are referring to is right of specific performance. See, right of specific performance is there the moment you have entered into an agreement. See, as long as you have, performed your part of the obligation or willing to perform, if you have entered into an agreement with a vendor, you have a right to sue him for specific performance that is always there. In fact, the courts have gone to the extent of calling the right to sue for specific performance as a distinct capital asset itself. See, that is not what is relevant here. The Supreme Court went on to say that the transfer itself has taken place in year 1, which is erroneous with due respect to the Supreme Court. Now, the 247(5), which has created some sort of ruckus because of the artificial situation that it has inserted into the law book, and making the landowner pay tax much ahead of the actual gain. What is the way out for us? See, it is not that what I give the list of would have to be considered as something which is novel, because you are already aware of it mostly. I've just added 1 or 2 new things. So just because I give a long list, it wouldn't have to be taken as my suggestion of these many matters, because I'm sure as practicing veterans you would have implemented most of these. We'll just take a look at a few of these and try to analyze and see as to what defenses could we take. One thing you'll have to appreciate here is most of these shouldn't be used as planning measure. They are more a defense mechanism. Because landowner wouldn't have bona fide offered anything to tax on the premise that I've just entered into JDA, I've not got anything, why should I pay tax now? And it is after 4 or 5 or 6 years, the department would wake up. Maybe on the basis of the survey that it would have conducted in the case of builder, a search in the case of builder, it would come to know all the landlord's details with whom the builder would have entered into agreements. It would get possession of various documents that would say that the possession would have been handed over by the respective landowners. Then the notices of reassessment could go to all these landowners on the premise that why their assessment should not be ripped open now. And at which point of time, landowner will come in contact with you. Most cases. So what defenses could you possibly take? The first is the very language of section 45, which I will be dealing with little more elaborately a little later. Just to introduce this particular line of defense, section 45 talks about the capital gains arising. It wouldn't use the word accruing. It just uses the word capital gains that arise, profits and gains that arise. So what is the legal implication? When in a particular piece of legislation, they use only the word arise unaccompanied by the word accrual, like how they have used in section 5. One aspect. Second